Hey guys, welcome back to my channel. My name is Rashad Murphy with Money News Management, and by now if you're watching, that means you have everything you need set up to become a tax-free millionaire. And if you haven't seen the video about how to trade within your Roth IRA, I will drop that link in the description below. And that way you'll be well on your way to make sure all of your trades and investments are completely tax-free. So I know as of late, we've been talking a lot about trading stocks and different methods of investments. Well, recently it dawned on me that not everyone has $1,700 to invest into Amazon, or $350 to invest in Tesla, or even the low of $260 to invest into Apple. So today on Money News Management, I'm going to teach you how to grow your IRA with mutual funds. So let's start with what is a mutual fund. A mutual fund, simply put, is a compilation of stocks put together by numerous shareholders and professionally managed to be traded and sold on the stock market. So what that means in non-finance terms is that a bunch of rich people who owns a bunch of stocks decide to get together, put their stocks into one fund, and allow a sworn fiduciary to divide it up and sell it to individuals like you and I. Meaning, in even simpler terms, that you and I are allowed to buy numerous amounts of stocks at a fraction of the price. Rashad, yes? Can you get to the point? I'm bored. Okay, well, my bad. So I understand that everyone has a lot of disposable income, or realistically, any disposable income. And that's why we're talking about mutual funds. Because with mutual funds, you're allowed to do something called purchase fractional shares. So a fractional share is just as it sounds. It's you purchasing a fraction of a share of a stock, no matter how much it costs. You pay a fraction of that price. When it comes to trading mutual funds, you're not purchasing a fraction of an individual stock. You're purchasing a share where it's compiled of fractions of individual stocks. And the beauty of a mutual fund is you can purchase a fraction of that mutual fund. And I'll give you examples soon to come. And really, when it comes to mutual funds, there are so many different types of mutual funds. So in order to explain them all would take a lot more time than I think you're willing to listen to me. So we're just going to name a few. There are mutual funds out there like target date funds, index funds, or special category funds. And what I mean by special category funds is something that you'll soon realize once you look into them is that most mutual funds are generally named after what they consist of, such as the Fidelity Intermediate Treasury Bond Index Fund, or FUMAX, which is composed of 99.54% of treasury bonds. If you don't know what a bond is, it's technically just a government loan. What you'll do is you'll give the government money and they'll keep it for a certain amount of time with assurance that they will give it back to you with interest. Now, of course, when I said mutual funds are compiled of many different things, and the first one I give you is only compiled of one thing, that's not really a great example. But I was just giving you the example for the name. The name says Intermediate Treasury Bond Fund, and all it consists of is treasury bonds. For the next example I'll give, it'll be Fidelity's Emerging Market Fund, which consists of so many different sectors with holdings in financial companies, technology companies, and energy companies, and a number of numerous other things, with stocks of companies like Alibaba or Samsung, with companies all over the world like in China, Brazil, India, and even America. Majority of mutual funds are diverse, just like this one, and consist of numerous different things from numerous companies from all over. And things like this truly help you diversify your portfolio while you're trying to learn how to invest. Another good thing about investing into mutual funds is that it diversifies your portfolio for you. So if you're interested in investing in something like technology companies, then you can find a mutual fund that consists majority of technology companies. And what that means is you can find a mutual fund with holdings in companies like Apple, IBM, Samsung, Microsoft, and numerous other technological companies that you're willing to invest in. And if you were trying to invest into any of those individually, you'd be out of about $800 with all of those added together. But with the mutual fund, they have holdings in any of those individual stocks, and you will get a payout for owning that mutual fund because the mutual fund owns those stocks. And what that means is now that you own that mutual fund, you own shares of all of those companies. Now, once again, you don't own one whole share of those companies because depending on how the mutual fund is set up, you may only own 5% of Apple and like 35% of IBM. So when it comes to the concept of how you make money inside of a mutual fund, it's based on how those companies within the mutual fund perform. So for example, if one company within the mutual fund is doing terrible, I mean, it is just plummeting, but it's only 2% of that mutual fund, your mutual fund won't actually take that big of a hit. But if one of the companies that's doing bad is compiled with maybe 35 to 40% of that mutual fund, then you'll actually see a decline in your growth. And considering the composition of a mutual fund and the fact that it's being professionally managed, generally you'll see something of a steady and consistent growth. Now, you're welcome to continue to invest into mutual funds for the long term, and that's completely fine. There are many people who do so. But me personally, I would suggest, especially if you're young, to invest into individual stocks so you can see aggressive growth at first. And by all means, when you start to feel like you've made enough or that plateau is hit, invest into something more conservative like bonds. Because when it comes to investing into mutual funds, your account really grows about a couple cents, maybe a few dollars a day, which is nowhere close to the aggressiveness of an individual stock. Because if you own multiple shares of those stocks, then they're growing by the penny or the dollar, and that adds up. Considering that you only own fractions of a share, your money will not grow as aggressively as if you just owned one individual share of a company that you believed in. But there is beauty in investing into mutual funds. Even though it's slow growth, your money is still making you more money. So you can continue to invest into mutual funds so your money can make you money while you learn how to make your money make you even more money. So think of a mutual fund like training wheels for millionaires. Now, of course, there are a few things I want you to pay attention to before you start to invest into mutual funds. Now, mutual funds does not require you to buy the whole share. Once again, these are things that can be purchased into fractional shares. Now, to explain what that means in depth, let's say that a mutual fund costs $100, but all you have is $50. You could actually buy $50 worth of that share, which means you own one half or a fraction of that share. When it comes to that fund making money, you'll just earn half of whatever the whole amount of that fund made that day. So if that fund made $2, then your profit would only be $1 because you own 50% of that share. And all of that is calculated into the dividend payouts as well whenever the dividends are paid quarterly, semi-annually, or annually. So of course, this is a good method when you're trying to build your IRA because you don't have to have a lot of money to start. And this is a lot safer than trying to invest into penny stocks. The next thing that I want you to think about when it comes to investing into mutual funds that you don't have to listen to me at all because who am I but some guy making investment YouTube videos in his living room. But when it comes to investing into mutual funds, you should always start with the most aggressive growth as possible. The reason for that is because it will help you build your account a lot faster. And I understand that everyone isn't accustomed to the volatility of the stock market, and you're not accustomed to those rise and falls. But when it comes to mutual funds, those gains and those losses are so small that you will rarely notice them. Now, of course, you will see them, but it won't make that big of a difference to you whether you lose 5 cents or gain 10 cents that day. But if you go with a conservative fund, you'll be slowly gaining maybe 2 cents, 3 cents here or there. Now, also take into consideration these low profit gains that you'll be gaining a day is also relative to how much money you're putting in there. So if you have $10,000 into one mutual fund, of course you won't be gaining like $2, $3 here and there. Your money will be relevant to how much money you have actually invested into that fund. But if you could invest $10,000 into a mutual fund, I'm pretty sure you might want to go look into some individual stocks. So the true purpose of this video is to help you realize that you could build your account to a point where you have enough money to start investing into stocks and ETFs. Rashad, what the is an ETF? Language. Okay, well, an ETF stands for Exchange Traded Fund. And I won't go deep into detail, but an ETF basically is the exact same thing as a mutual fund with closer classifications in its categories. If it's a real estate ETF, it will have all real estate companies inside of it. If it's a technology ETF, it will have all technological companies inside of it. The difference between an ETF and a mutual fund is a mutual fund, you can have a diversity of things in one fund. An ETF has a close classification of all its shares and stocks of the same companies. If you want to invest more and solely into technology but can't afford those stocks, you would try to find a technological ETF. Now, the only difference in an ETF and a mutual fund is you cannot trade ETFs as fractional shares. So that's enough about that because this video is about how to make more money with little to no money. Something else that you probably want to consider when you're investing into mutual funds is looking for something called a target date fund. Now, this isn't for everyone because it definitely has slow growth. But if you do want to keep a mutual fund in your portfolio, then this would probably be something that you like. Because what a mutual date fund is for is a fund that's set towards the date of your retirement. So they expect that steady and consistent growth to reach a certain point by the time that you're ready to retire. Now, you might be asking, how the f would a fund know that I'm ready to retire? In reality, they don't, because a target dates fund is actually set up for set dates. And if you're wondering what day that you'll be ready to retire, all you do is take how old you are now and figure out what year you'll be 60 in. Because when you think about the concept of an IRA, that's what it's set up for, an individual retirement account, which is simply when you're ready to retire. So a target date fund is just aiming for that date. So if you want to trade a target date fund, that's all you have to figure out. What year will you be 60 years old in? A target date fund is set up to grow consistently, but very conservatively to reach a certain point by the time that you've reached that date. So of course there's a major catch when it comes to investing into mutual funds. It's not that big a deal, but of course it's something that you should be aware of. Now, because mutual funds are being professionally managed, that means someone has to pay them. Unfortunately, that someone is you. And what that means is every mutual fund comes with something referred to as an expense ratio. An expense ratio simply is just how much money you'll be paying out annually based on how much money you have invested into mutual fund. Now, every mutual fund has a different expense ratio. An expense ratio is simply just a fee. And if you don't have a lot of money invested into mutual funds, 9 times out of 10, you won't be paying that much money. But this is for those who believe that a mutual fund should be constantly inside of your IRA. Because for me, using a mutual fund is simply just to help build your account. It has nothing to do with long-term investments. But if you do choose to invest into mutual funds long-term, this is something that you definitely should be aware of. For example, if you have $100,000 invested into mutual funds and your average expense ratio is 0.07, that means you'll be paying $8,500 a year in expenses. And yeah, I understand that to some that's not a lot. To have $100,000 and only have to pay $8,500 in fees, but to me, I don't want to pay any money in fees, and that's why I would invest into normal stocks. And take into consideration that some actually have higher expense ratios. Not all are that high. There are actually some with 0.001, 0.03. Usually, a higher expense ratio just means it's more aggressive in growth. But that's not always the case. Sometimes it just means that they're moving the stocks around a lot. And since they have to do more work, you have to pay them more. Now, also take into consideration that having a low expense ratio doesn't necessarily mean that that mutual fund is better. But it also doesn't mean that it's any worse than one with a higher mutual, because some companies just pride themselves on having low expense ratios. And that's why it's always important to make sure you do your research when it comes to trading anything. Because when it comes to buying anything, a stock, an ETF, a mutual fund, or anything in regards to investing, your portfolio is simply up to you because it's supposed to be tailored to your individual desires and needs. If you have any questions on how to tailor your portfolio, feel free to drop a comment in the comment section below or contact me on any social media platform. My Instagram and my Twitter are both the same, @obey_Murphy. And of course, I'll drop links to both in the description below, along with the link to my IRA video. I would also like to point out that none of this is an affiliate link. So therefore, I don't get paid for sending you to Fidelity or Robinhood. I simply want to watch everyone succeed and increase their financial literacy. And the reason I say that is because you don't have to invest with Fidelity. There's numerous other companies out there that will do generally the same thing. You can trade stocks on apps like Webull or M1 Finance, and you can invest and open an IRA with people like Charles Schwab or Ameritrade. There are so many other companies out there that do exactly the same thing. So in reality, all you would have to do is a little research to find out which one works best for you. And in today's market, trading is actually completely free across the market. So you don't have to pay a fee when you want to buy or sell on any platform. So that's no longer a thing that you need to consider. But in case you're considering trading mutual funds or ETFs, the expense ratios might be something you would like to look at. And with all that being said, I just want to say thank you for watching this video. And if you're looking forward to more content about investing and increasing your financial literacy, then don't forget to subscribe to the channel if you haven't already. And please leave a like on the video to show your support because it's greatly appreciated. And stay tuned because there's plenty more content on its way to help you manage your money.